this interview about the prospects for the property and buy-to-let market in 2023, I am joined by one of my favourite property people. It's Jason Harris-Cohen. And I love talking to you, Jason, because you wear quite a few hats when it comes to property. You're a landlord, a property developer, you've got property-related businesses. So you have a very wide view of the whole sector. I guess a good place to start is, has 2023 got off to a busy start for you?
It hasn't been, I think. It's a lot busier than it was at the Q4 2022. Obviously, we had a disastrous end to the year in Q4 after the much talked about mini budget. Everything went AWOL for a while. So it's good to get a lot more stability for sure. I think on the buying side, we've seen a lot more opportunities. So, that's led to us being able to be more selective. Whereas at the end of last year, so we had that pause period, and I think there was that inertia, especially with the traditional slowdown coming up to Christmas, when a lot of people, I think, just stopped and didn't really want to do anything. So we started off the year, I think a lot of people now, we've got the sort of over 1.5 million people this year who have to refinance. So I think we're going to see a lot more people who have to move now. So definitely seeing more supply come to the market. In terms of the selling side, I think agents are typically reporting they're a lot busier than they was at the end of last year, but still there's quite a big gap between sellers' expectations and the prices buyer wants to pay. Someone said to me the other day, sellers still think it's sort of 2021 and buyers think it's 2008. So, I think there's a bit of that going on, quite a gap between expectations and realistic prices. But I think as long as you're realistic in the pricing, then we're not having any trouble selling at the moment.
Okay, so you personally, when we've spoken before, you maintain a kind of core buy-to-let portfolio yourself, quite a substantial portfolio, and you occasionally sell one, you acquire one, you do some developments. Has that changed at all, or are you kind of business as usual of what you've always done?
I think 2022 was a very busy year for us. We acquired about 100 properties and we sold about 80. So of the stock that we've owned for several years, some of it was just general trading. I like to consider ourselves as asset managers, and I think more so now than ever, because you have to be more creative, look at ways to innovate, adapt, find other opportunities to add value. And what we're looking at now is most of the properties we look at, we're just looking at the best way to asset manage them, whether it's still planning gain, redevelopment, looking at higher income producing properties. Really, we was in, money was so cheap, and I think that this kind of Goldilocks period's over now, when people were getting drunk on cheap debt. And now we've come to reality of actually, we're going to have higher interest rates for longer. And we've had to adapt our strategy quite quickly from the start of last year, as we expected that interest rates would have to start rising, as they did. What that's meant is essentially our old business model. We used to mainly, a bit like a fund manager, we used to aim for about 7% gross yield, and we used to be financing at about 4% on a 5-year fix. We like to have interest rate certainty, so we used to try and fix for longer. Once, especially after the budget, our borrowing rates was getting quoted 6.5%-7% on comparable 5-year products. So it made the 7% gross business model very unviable, which is why we took that period to pause. How we've adapted is we're now looking for high yielding properties. So whether that be by other different types of investments like supported living, and rehousing, looking at the enhanced local authority rate, but mainly just looking at high yield areas. So instead of maybe Manchester, looking at greater Manchester, areas like Wigan and Warrington, looking at more closely at suburbs of Sheffield and Doncaster. And also we always seem to find quite high yields in Liverpool, 8% plus, even some auction lots. I looked at a property the other day, a terraced house that was yielding 10% gross. So we're able to then increase our net yield. Our borrowing rates are higher when we're refinancing the properties on buy-to-lets. Typically at the moment, about 6% were being quoted. I think have been quoted this week at 5.8%, but there's quite a hefty fee. So it is settling, although borrowing rates, Bank of England base rate is expected to keep increasing throughout the year. Actually, lending rates are coming down. There's a lot more competition between lenders, and we've seen a lot more stability and recovery in sterling, and also bond yields are reducing. So, it is quite positive. I feel like the Bank of England have probably increased rates too fast. And I think that actually the damage has been done to the economy. I feel, just general my own sentiment and speaking to a lot of friends and consumers on a daily basis, I think consumer sentiment is very low. And I do feel strongly that, a lot of this inflation has been caused by supply chain issues, the fallout from the pandemic, global huge increases in commodity prices. And we've seen, fortunately, quite a fall recently in fuel prices and gas prices. But, unfortunately, that's not going to be passed on to the consumer for the foreseeable future, especially relating to energy, because of how we've had the price cap. So sort of going, I am still, it's a sector that I am very passionate about. We are long-term landlords. We are keen to continue scaling our portfolio. But mainly we've just had to adapt, and we've done that, as I say, by looking at higher yielding properties that are aiming now for a minimum net yield of 7.5%, 8%. The higher the better. We do sort of really look to get about 9 or 10%, but we would look very closely and seriously at properties that are netting, say, about 8%. Refinance at, say, 6%, and then we've got a 2% net margin, and we'll just do that in scale.
Okay, so that's the yield side of the equation. What about the capital growth side of the equation? Because you've got a lot of stock in the southeast, which will have done very well through capital appreciation over the last few years. You're kind of diverting up north where it's more about yield. What's your view on kind of capital appreciation over 2023? Are there going to be price corrections? Is it going to be stagnant, or is it just too hard to tell because we're in kind of uncharted waters?
I do think we're going to see price falls, unfortunately. I think that's happened. I think for us, we're a bit like the sort of trading mentality, like stock market, and that we're foresighting the future and we're looking ahead and where there can be green shoots. But I think a lot of the price damage was done at the end of last year, especially to consumer confidence and the recession. And in terms of how many buy-to-let investors are now looking to leave the market. I've never known a rental crisis like it, unfortunately. It's scary, the amount of applications that we're receiving on each property we list to rent. My view on the market, I believe prices will fall from the peak at about 10%. I hope there won't be too much more damage than that, because I think fundamentally there is a lot of people who have to and want to move. And actually, if we compare the first quarter of 2023 to the final quarter of 2022, actual borrowing rates are significantly less now from where they spiked shortly after the budget. So essentially, anyone who was in the market to buy then, and it was still fairly active, on the selling side, as long as, again, it all comes down to pricing is key. Be realistic in your price and you will sell. Give it the curb appeal. Do what you can to present the property in the best possible light, but you still will sell if you price realistically. And I think that we will see, my view is on my own portfolio and stock that I've brought to the market since, say, the final quarter of last year, I'm pricing it at about 7%, 7 to 10% below where it would have been in earlier months. And that way, the market will dictate the real value. So if I've priced it, too conservatively, I will get multiple bids on the property and it will lead to a better price, like we're seeing at auction every day. Set a guide price, the reserve price is higher than that. And as long as it's priced correctly, the property will usually sell in excess of the guide price.
Okay.
So I'm kind of trying to create my own market instead of pitching too high. And we just won't have any interest and there'll be one person to choose from, do the reverse effect, go lower, create your own market, get the competitive interest, and that will dictate the true value.
Okay. Well, I guess that applies to both sales and lettings in terms of pricing it correctly in the market to get a good choice of prospective buyers or tenants. But one of the businesses that you have is you have a quick house purchasing business. And many of people on Property Tribes will remember that I mentioned my friend Jason, who is my trusted source for professional, fair cash buying service of properties. I'm curious, Jay, if you've got an uptick in landlords coming to you wanting to sell, because we're seeing concerns about rising interest rates, EPC ratings, the abolition of Section 21, Section 24, lots of reasons for landlords to feel like, I've had enough. Is your phone ringing off the hook with landlords wanting to sell up?
It's a very competitive market, as you know. I think a lot of people, we set up this business in 2014. We've completed over 1,000 transactions since then. And when we come into the market, there was a much smaller pool of companies to go through. And I think as technology's evolved, there's so many deal sources out there now. There's people canvassing their roads and their local areas, along with their own local advertising. It is a much more competitive market. I think, firstly, our brand presence has increased significantly, in the years since we've been in this business. Our reputation is pretty unrivaled in the sector. So, as we said, it's all about us, fairness, transparency, providing the best service we can to our customers, sticking to our word, which is why we've completed so many transactions. We are seeing a huge increase in landlords. Last year, we bought several significant portfolios, one of 13 units in Weston-super-Mare, 10 properties in Wigan, and also a block of 12 flats on the Isle of Wight.
Wow.
Along with significant smaller portfolios, a few of, 4s and 6 properties. I think it is unfortunately sort of perfect storm for why landlords would want to sell at the moment. As I said to you earlier, how many properties we sold last year. I'm fed up on certain properties underperforming. I'm coming to the end of the expiry on the fixed term mortgage. It's unviable to let it. As you alluded to earlier, some of the properties we did have quite a strong presence in the southeast and Greater London. Unfortunately, whilst in the future there might be capital growth there and higher than other regions, actually they're just underperforming on a yield basis, and it would be costing me money potentially to hold them properties now. Some of them, I've seen a lot more growth in houses than flats. I've got some flats in Greater London that are worth the same as they were 3 years ago. So, it's not all sort of blue skies, unfortunately. And then properties which were underperforming, after my buying and selling cost and improvement cost, there's few of them I've even lost money on. But I was keen just to withdraw the equity and reinvest it on better cash flow producing properties. So there's been quite a lot of realignment in the portfolio. As I say, we're actually a lot more now heavily weighted north of Milton Keynes. And we've got rid of a lot of properties in London and the southeast, because typically we're not a HMO investor. Although we do own HMOs, it's not our core business model. We prefer to stick to single assets, freehold, without service charges and ground rents in northern powerhouse regions. And I think that, one of my big concerns is the change of government. How are Labour going to treat landlords? Because it's not exactly been a great process with Conservatives. So, how is it going to be when we have a lot more left-wing government? And therefore, how are we going to sort of risk stress our business for that? As I'm sure all landlords, speaking on behalf of us, we're all very deeply worried about the EPC regulations. How is it? It's just not possible to get most of our properties with an average E rating to a C retrospectively, with tenant disruption access. So there's been quite a lot of realignment, as I say, and I think that we just have to keep on adapting really to what's put in front of us.
Well, I think that's one of the values of being a member of a community like Property Tribes is, it is a hive mind. None of us is as smart as all of us. And we can hear from people like you who are very much on the cutting edge of everything, and see how you're approaching it. And I think you're right. It is a case of, keeping aware of what's going on and, adapting what you're doing to deal with the market conditions. We kind of call it being a sovereign investor, because you can only control the things that you can control. You can't control government policy. You can't control which political party is in power. You can't control what the Bank of England is going to do.
Yeah.
All you can really control is the things in your business that you have control over, like your properties, like the quality of your tenants, and so on. I know one thing that you were very personally concerned about, Jason, was the removal of Section 21. There's so much hyperbole about it in the media, but you just hit on something very important there. You may need to ask a tenant to leave to upgrade a property because it needs to meet the higher EPC rating dictated by the government. So there's lots of legitimate reasons why people serve a Section 21. And I think something like 92% of tenancies are ended by the tenant, not the landlord. And you have expressed to me in the past that you appreciate the certainty of having Section 21 there if you need it.
Yeah, I think it is incredibly important for landlords. I think there's so many reasons, especially now financially related, and for the baby boomer era, which makes up such a large majority of the private rented sector. And we're seeing they're coming to an age, my business partner is 72. He's at an age where he wants to start slowing down a bit. And that means consolidating assets, taking away stress. Very common reason for people looking to sell. Go and move abroad, go and buy a holiday home, travel the world more, etc., catch up with family. We've all learned from the pandemic, life's too short, and maximize your opportunities. And I think for that reason, that's the key reason alone why Section 21 is imperative, to be able to have option, of being able to realise an asset if you need to, or if you want to. It's a free country. If I put money in a savings account, as long as it's not in a fixed term, I can break that. If I put money into stocks and shares, I can sell them and crystallise, the asset when I want to. And although property is a lot more liquid than a lot of asset classes, by putting that huge barrier to entry in place and not allowing landlords to sell an asset when they need or have to, it would just be disastrous to the PRS. One thing I would like to say, I think Ben Beadle has been exceptional at the NRLA. I think what he's been doing, along with yourself and Nick, Kate Faulkner, it's brilliant to have you guys behind us. I think, I've seen the regular interviews, and the lobbying of the government, and I think they need to know what carnage they will cause. As I say, we all thought, I voted for Conservatives in the last election. I'm very disappointed how they've treated people in some respects, like everyone with their strengths and weaknesses, but overall it's not been a great performance, which is why, Labour look odds on at the moment to win the next election. But I do think that Labour need to understand as well that, if they cause more issues for landlords, if they introduce rent controls, if they abolish Section 21, if they introduced a mandatory right to buy for private tenants, they would just have a mass exodus of landlords, and they wouldn't end up with any rental properties. And I personally would leave the sector. I would probably leave the country, to be honest. But I think it would be time to sell up. And I know my business partner says 72, and I think he would quite like to go and get a deck chair in Barbados and move there probably. But that's a conversation for another time.
Yeah, well, whenever I do my media appearances, I did Newsnight this week, and one of the things that I always try and say is that the difference between the mortgage, assuming a landlord has a mortgage, and the rent is the landlord's margin. And that margin is to compensate them for taking on the risk of a tenant who does not pay the rent and or who, damages the property. And like any entrepreneur, which we are as landlords, we carry the risk of the business and we have to be compensated for that. And if that margin gets too much slimmer, it's just not going to be worth being a landlord anymore unless you've got very, very significant other income and you're just doing it as a pension hedge, long-term capital growth. So, the government do need to wake up to all the collateral damage that they are causing in the housing market by their anti-landlord policies.
No, 100%, Vanessa. I couldn't agree with you more. And I think, we're all affected by inflationary costs. The cost of my boiler replacements have increased. The cost of my electrical inspection reports and gas safeties has increased. And when I've got service charges on leaseholds, my service charge has increased for the whole block. And, some of it's significant amounts, along with, major work, Section 20s, fire safety, following the tragedy at Grenfell. And then, the dreaded EWS ones. Unfortunately, we've got a few flats there that we've unable to sell because of cladding issues. So, for landlords, we all have staff who want more wages. Offices, rents are increasing. And all the other inflationary costs that everyone's being affected by. So, it's very difficult to now make a profit, especially on a smaller portfolio. And, that's owning it within a company, let alone, if you've got Section 24 and owning the properties personally.
Yeah, because the cost of living crisis doesn't just affect tenants, it affects landlords as well. We're affected by it in many, many different ways. But just as we close this out, Jason, I think there was one other person you wanted to give a shout out to.
Yeah, I forgot to mention Paul Champlina. He's a good friend of mine. Yeah, he's a good friend of mine. Always love listening to his, lobbying as well of different government policies and departments to, support landlords. So, great job to everyone I've mentioned as well, and thanks for all your support.
Okay, well, it's lovely to hear your views on all of this, Jason. I know that you're a family-run business. Your family have been in property for many, many years. You're very committed to it, as you mentioned earlier, and it's really interesting to hear that you are going to continue on, but you're keeping a beady eye out to see how it's all panning out, and you're making your decisions just really based on what you're seeing, the way the market's going.
That's right, Vanessa. Yeah.
Awesome. Well, Happy New Year to you.
Yeah, Happy New Year to you. Good to see you. Hopefully catch up with you as well soon. Have another update on the market. It's changing. The outlook's changing quite quickly at the minute. So hopefully more positive news in the next conversation.
All right. Well, thank you very much, Jason. All right, and all the best.
All the best. Good to see you. Bye. Bye, Nick.
Bye.